Folks, let's analyze the market trend for next week, January 12th, 17, by combining this week's market movements and news flow. During the first full trading week of 2026, January 5-9, the three major U.S. stock indices trended upward with fluctuations, with the Dow Jones Industrial Average. Market volatility picked up this week. On January 7th, the Dow dropped 0.994% in a single day. The S&P 500 retreated. Sector rotation was pronounced this week, with pro-cyclical sectors leading the gains. Consumer discretionary, up 5.8%, and materials, up 4.8%, outperformed the broader market, while utilities was the only sector to close in negative territory, down 1.6%. Internal divergence within the technology sector widened, driven by expectations of a shortage and price hikes in memory chips. Stocks related to the AI industry chain staged a strong performance, with Micron Technology surging 20.91% week-on-week, closing at $345.09 on January 9th, 2026, a sharp jump from its December 31st, 2025 opening price of $285.41, and SanDisk skyrocketing 27%. Google climbed 4.5% to a new all-time high, and Amazon logged a weekly gain of over 8%, while Apple and Nvidia posted slight declines of 4% and 1.6% respectively. This reflects that the market has adopted more stringent stock-picking criteria for tech giants, moving away from a one-size-fits-all approach. The healthcare sector continued to exhibit defensive attributes, rising against the trend amid the broad market sell-off on January 7th, and delivering steady overall performance this week, making it an important pool of value investment targets. The energy sector saw heightened volatility due to geoeconomic risks between the US and Venezuela, with its weekly gain narrowing to 2%. The real estate sector lacked clear policy catalysts and was mainly driven by interest rate expectations. In addition, the U.S. House of Representatives passed 3 government funding bills on January 8th, alleviating concerns about a government shutdown on January 30th and providing support to related sectors. The December ISM Services PMI released on January 8th rose to 54.4, moving upward for 3 consecutive months and beating market expectations, with multiple sub-indicators returning to expansionary territory. The Atlanta Fed's latest revised data for Q4 GDP growth rate has not been updated yet and warrants close attention going forward. Monetary policy expectations, rate cut bets, continue to cool. June cut becomes consensus view. Strong economic data has adjusted market expectations for the Federal Reserve's monetary policy. According to CME FedWatch data, as of January 2nd, the probability of a rate cut in January stood at a mere 14.9%, and the probability for a March cut was 51.2%. Currently, the market widely expects the first rate cut to be most likely delayed to after April, with the second cut potentially around September, mainly due to the economy's stronger-than-expected resilience. FactSet data shows that S&P 500 constituents are projected to post an 8.3% year-on-year increase in earnings and a 7.6% YoY rise in revenue for Q4, with the information technology and financial sectors leading the growth charge. The S&P 500's current forward price-to-earnings ratio stands at 22 times, above its 5-year average. The market is focusing on tech giants' AI business profitability and capital expenditure plans, with significant divergence among institutions regarding the AI boom. U.S. stocks are expected to extend their oscillating upward trend next week, with the S&P 500 poised to challenge the 7,000-point level and the Dow moving toward the 50,000-point mark. However, volatility may rebound, and sector divergence will persist. Supporting factors include stronger-than-expected economic resilience, earnings growth expectations for the earnings season underpinning market sentiment, and expanding pro-cyclical rotation, broadening the rally's breadth. Risks to watch out for include higher-than-expected inflation, earnings misses relative to forecasts, and short-term pullbacks triggered by the 10-year U.S. Treasury yield, breaking above the 4.20% resistance level. For sector allocation, investors can focus on earnings certainty and rotation sustainability. Priority should be given to the AI industry chain, memory chip stocks, and high-quality financial stocks. Seize pro-cyclical opportunities in industrial cyclical stocks and leading consumer discretionary names, and allocate to defensive hedges such as healthcare value stocks and leading consumer staples players. In the short term, it is advisable to avoid highly sensitive sectors like energy and real estate. Key items to watch next week include U.S. December CPI data on Tuesday, January 14th, and PPI data on Wednesday, January 15th. Inflation figures will influence rate cut expectations. Q4 earnings releases from financial institutions, including JP Morgan Chase and Goldman Sachs, on January 15th. Investors should pay attention to earnings details and updates on their AI businesses. Policy signals on monetary policy from speeches by multiple FOMC members. The performance of the 10-year U.S. Treasury yield around the 4.20% resistance level. The above is the forecast and analysis of the U.S. stock market for next week, hoping to provide a reference for your investment decisions. Don't forget to like, follow, and share.